Capital markets education is not complete until you understand how ownership economics actually works. Financial models forecast revenue, legal structure determines how you can raise, but the cap table determines how value is distributed. Today, we're going to break down what a cap table is and why it matters, how dilution works, preferred versus common stock economics, waterfall analysis and payout priority, liquidation preferences, conversion mechanics, and practical investor thinking around equity rights. This episode is about ownership economics, not valuation theory, and that's what separates casual investors from capital market investors. What is a cap table? Cap table is short for capitalization table. It is the ledger of ownership. It lists all equity holders, the class of equity held, percentage ownership, any convertible instruments, rights attached to each class, vesting schedules, option pools, warrants and convertible securities. Cap tables evolve over time. They are not static. And for investors, cap tables are the truth about who owns what and under what conditions. A cap table tells you how much of the company you own, what happens on an exit, what happens on a future round, how dilution impacts returns. If you don't fully understand the cap table, you don't understand your investment. Why cap tables matter to investors? Investors care about cap tables because they determine ownership percentages, voting control, economic participation, liquidation rights, future dilution curves. Let's ground this in real mechanics. Suppose a company has 1 million outstanding shares at present with founders owning 80% and early advisors owning 20%. In a raise, new investors may buy 400,000 new shares. What happens? Total shares increase to 1.4 million. Founders are diluted from 80% to about 57%. Advisors are diluted from 20% to about 14%. New investors own 29%. That's dilution. But dilution itself is not inherently good or bad. What matters is value per share. If the raise enables growth that increases enterprise value by more than the dilution cost, investors benefit. If not, dilution destroys value. Equity classes, common versus preferred. Most investors receive common stock, not preferred stock. Let's talk about preferred stock. It generally includes liquidation preferences, which is a priority on exit proceeds, anti-dilution protection, which is protection from future rounds at lower valuations, dividend rights, cumulative or non-cumulative, and conversion rights, ability to convert to common stock on exit. Common stock is typically held by founders, early employees, or often in crowd fundraisers. Investors often accept preferred stock because it gives them priority and downside protection, but the specifics matter. Liquidation preferences. A liquidation preference determines how exit proceeds are distributed. If the preferred stock has a 1x non-participating liquidation preference, it means investors get their initial investment back first. Then the remaining proceeds are shared among remaining equity holders. If the preference is participating, investors get their preference plus share in the remaining equity alongside common. For example, a company sells for $10 million. Preferred investors put in $2 million with a one-time non-participating preference. Investors get $2 million first, remaining $8 million is shared pro rata. With participating preference, investors get $2 million, but they also share in the remaining $8 million pro rata. That participation structure can dramatically change returns and valuations. Experienced investors always dissect preference mechanics. Anti-dilution protection. Anti-dilution provisions protect investors in down rounds when the company raises at a lower valuation. Two common types exist: full ratchet anti-dilution and weighted average anti-dilution. Full ratchet allows adjustment of investor price to the new round price regardless of size. Weighted average takes into account the size of the new round. Investors accept anti-dilution provisions because they reduce downside risk, but they also make future rounds more complex. Convertible instruments, notes, and safes. Convertible notes and safes, which are simple agreements for future equity, are common instruments used in early rounds. Investors put in capital without a defined price per share today, but the securities convert in a future price round. Key elements include a conversion trigger, usually the next price round, a discount, a percentage reduction on next round price, valuation cap, the maximum effective valuation they convert at, and interest. Those may accrue. From an investor's perspective, cap tables must show how these instruments convert and at what effective valuation. Contracts without clear conversion mechanics lead to disputes. Waterfall analysis. Who gets what and when? A waterfall analysis simulates proceeds from an exit through each layer of capital rights. This is essential for investors because it shows how preference stacks affect payoffs. It clarifies breakpoints where common begins to receive proceeds. It allows investors to model returns under exit scenarios. For example, in a $20 million exit, first, the liquidation preference is paid. Next, any accrued dividends or interest. Then remaining proceeds flow according to share classes. If preferred has participation, those mechanics alter the distribution significantly. Investors who fail to understand water flow math risk overestimating returns. Cap table stability and future rounds. The structure of a cap table affects not just ownership today, but future raises. Investors look at option pool size, reserve shares for employees, unissued warrants, convertible instruments outstanding, and potential dilution from future rounds. A healthy cap table balances founder control, employee incentives, and investor protections. Too many reserved shares for options reduce investor upside. Too much preference protection can trap founders in structural conflict. Good cap table design improves long-term scalability. Voting rights and board seats. Cap tables often interact with governance. Investors may require board seats, observer rights, protected provisions, reserve board approval for major decisions. Voting rights determine governance stability. Investors who don't pay attention to voting classes often underprice governance risk. For example, Class A common may have 1 vote per share. Class B preferred may have 10 votes per share. That structural imbalance affects control. Cap tables must reflect voting shares along with economic shares. The key takeaway for investors. Cap tables are not abstract spreadsheets. They are economic truth. A cap table tells you who owns what preference exists, how your return unfolds upon exit, what dilution you can expect, and how governance rights are structured. Investors who can read cap tables confidently eliminate blind spots and price risk accurately.